Assalamu alaikum. This is lecture 43 of Advanced Cost and Management Accounting. We are going to discuss the topic of capital investment decisions. So, what are capital investment decisions? These are decisions that involve capital investment. From your financial accounting courses, you will be familiar that there are two categories of expenditure. One category is capital expenditure and the other category is revenue expenditure. What is the difference between capital expenditure and revenue expenditure? Essentially, the difference is in the useful life of the expenditure. Capital expenditure is expenditure on items or equipment or such goods, assets which have a longer useful life. Longer than what? The standard for measuring the period of useful life which determines whether expenditure is capital or revenue is 1 year. So if expenditure on an item where we expect the useful life of the item to be more than 1 year, this is classified as capital expenditure. Whereas, therefore, expenditure on items where the useful life is less than 1 year, these are revenue expenditure. Now, examples immediately will come to your mind where if we are spending money on salaries and wages, let's say salaries are paid every month, so the expenditure really has useful life of 1 month. Electricity bills are paid usually every month, so that expenditure is useful for 1 month. Rent is paid every month, so that expenditure has a useful life of 1 month. Or in case it could be longer, if rent is paid for 3 months, then the useful life is 3 months, and so forth. This is all revenue expenditure. Other items can be consumable items, stationary items. Stationary items you will acquire, purchase, and they will be used. And within a short period, so stationery will become a revenue expenditure. Postage and courier and communication, all these are examples of revenue expenditure. Whereas items such as purchase of plant, machinery, equipment, computers, vehicles, buildings, things of this nature, where the expenditure that you incur, the service or the usefulness of that asset purchased is expected to be more than 1 year. Buildings are going to be several years, vehicles are going to last for several years, plant and machinery will be lasting for several years, furniture, etc. So, furniture and all these things will have different useful lives. They will not be the same, but they will be expected to last for more than 1 year. Therefore, all this kind of expenditure is going to be classified as capital expenditure. This is capital investment. When normally do you expect organizations to incur capital expenditure? First of all, at the start, if you are intending to build or set up, establish an organization which is going to do some business activity such as production or trading, whatever, you are going to require some premises where you are going to require equipment and furniture. If it is production, then you will need some plant and machinery and all those things. So set up and establishing a business organization requires capital expenditure. Then for ongoing business operations, if an organization decides to add a new product, and that new product can just be a variation of their existing products. In food industry, for example, if they are manufacturing fruit juice, if they decide to change the size of their packet, the packaging size, so a new packaging size is introduced, it might mean you need to acquire different machinery for this different package size. So that's where, if you are adding a product, altering your existing product, bringing in a new product, when you bring a new product, you might need a stream of operations, a string of machines to complete the entire process. And so bringing in new products, changing or variation in your existing products, this is going to need capital expenditure. Where you are going to incur expenditure on research to develop a new product, that research is also an investment. And where the benefit from the research is expected to last over several years, then that can also be included as capital expenditure. So these are the different types and different times when you are going to incur capital expenditure. Other examples could be if you are going to expand your warehouse. You need more storage space. You need a bigger warehouse. You need to install a new racking system in the warehouse. That's capital expenditure. If you need to build a separate block of buildings, a separate block, if you need new buildings to house either your staff or the machines for expansion, etc., that is also regarded as capital expenditure. So these are the different types of situations where you need capital expenditure, where you might incur capital expenditure to expand your facilities, not only to expand your storage or warehouse facilities, to expand your production facility. Just to increase the capacity, you might need more room, more machines to increase the production. So all this is capital expenditure. If you purchase cars for your employees, that is capital expenditure. If you have packaging areas and where you need to have new equipment, so modernization is another area of capital expenditure. You need to modernize your plant, you need to modernize the machinery, or you need to modernize some facility, the warehouse facility, the packaging facility, so forth. So these are all examples of capital expenditure. And these decisions, we are going to examine that when we make capital expenditure decisions, then what are the things that we should bear in mind, how to make these decisions, how to evaluate these decisions. Those decisions that involve current outlays in return for a stream of benefits in future years. So capital decisions are those decisions that require current outlay, means that you require to make the expenditure at the present time. So you require to spend now, invest now, and therefore it is a current outlay, and you expect a stream of benefits in future years. This means that you expect a return year after year for several years. So this is what capital investment involves. Spending now on items which are going to provide benefit and return over several years in times to come, future periods. Therefore, as we said, the expenditure is that expenditure which has a useful life of more than 1 year. Expenditure now, return over several years. Capital investment decisions are those decisions where a significant period of time elapses between the outlay and the recoupment of investment. Outlay means that you are going to make the expenditure. So spending the amount, and there is a period before you can recoup. Recoupment means to get a return and get it back. So you make an investment, and this is an expectation that over several years you are going to have a return, and therefore your money will be returned, or you will get it back over a period of time. So there is a significant period of time that can elapse before you get your investment back. Capital investment decisions normally represent the most important decisions made by an organization, as they commit a substantial portion of available resources. So we are saying that these are the most important decisions made by the organization. Important because usually the amount of money being spent on capital items is going to be large. It's going to be a significant portion of the available resources. Whatever resources you have, whatever capital you have to make and to conduct your operations, the purchase of machinery and assets, etc., as we mentioned earlier, those assets are going to involve a large amount of that total capital sum. So therefore, it's an important decision. You will be spending a large amount of your resources, so it should be carefully thought out, and it should be carefully analyzed, and there should be good information about the benefits of making that expenditure. A business firm's investment decisions include plant and machinery, research and development, advertising, and warehousing facilities. So we have discussed a large number of various types of expenditure that can be incurred and classified as capital expenditure. And we have also seen situations where capital investments are likely to be made. And we have said that these can include the equipment and machinery. They can also include research and development. But from your, again, the financial courses, financial accounting courses, you will know that in order to classify research and development expenditure as capital expenditure, certain criteria has to be met. Criteria relating to the development of the product, the stage of development, and the likelihood of future benefits. So that's the concept, and that's why we don't regard that as revenue expenditure, and we don't include this expenditure in our income statement. because the benefit is going to occur over several years. Therefore, we are going to match that benefit with the cost and therefore apportion the cost of this investment over that period of benefit. Investment decisions in the public sector include new roads, schools, and airports. So just to understand this concept of capital expenditure, we are also discussing the private sector and the public sector. Private sector are businesses and corporations that are run to earn a profit essentially, and the public sector is that sector which is governed by the governments and the regulatory bodies, and their essential aim is to provide convenience and provide facilities and service to the public. So in the public sector, we are saying the capital expenditure could be roads and schools and airports and transport and bus stations and things of that sort, railway stations, railway lines. Those are all types of expenditure which is capital expenditure in the public sector. We will assume that all cash inflows and outflows are known with certainty and sufficient funds are available to undertake all profitable investment. So this is an assumption. First of all, the assumption is that the cash inflows and outflows. Inflows are that where cash is coming into the organization. That means some sales are being made and this is revenue. And cash outflows. Outflows are those where you are making the expenditure, incurring the cost. So the assumption is that these are known with certainty. Now this is of course just an assumption, as most people will know that these are projections in the future and no one can know the future with any certainty. So in actual fact, in reality, the inflows and outflows might not be the same as those projected. Anyhow, we are going to ignore that uncertainty that we make a projection and what happens if the inflows and outflows are different. So our workings and our discussion will be based on the inflows and outflows of cash being known with some certainty. Also, we are going to assume that if this is a profitable project, then the funds are available to make the investment. Now, as we know that all organizations have some degree of limit on the availability of resources. So again, this is an assumption. And very often, organizations will have to choose between the projects that are available. If there are 3 projects which a firm can do, all 3 of them are profitable, all 3 have a good evaluation and positive cash flow, it's not necessary that the firm will have the funds to do all 3. So it might have to choose. So initially, we are going to go with the assumption that the funds are going to be available. What happens now? How to select an investment assuming the funds are available. Objectives of capital budgeting. We are going to discuss 3 basic objectives of capital budgeting. There are 3 categories of objectives. And these 3 categories are, first of all, determining which specific projects a firm should accept. Secondly, determining the total amount of capital expenditure which the firm should undertake. And thirdly, determining how the total amount of capital expenditure should be financed. However, financing decisions will form part of the corporate finance course. So we are talking about three objectives. One, to find out, to determine which of the projects should be undertaken. If you have a project in front of you, there are proposals, then how to decide whether or not to accept that. Secondly, the other objective of capital budgeting. So this is a capital budgeting, and this capital budgeting essentially is your capital expenditure plan. So within the plan, you are going to highlight which project should be accepted and how much total expenditure should be incurred. And in deciding how much expenditure should be incurred, the firm is going to take into account the available resources and the possible sources of finance. Now, how to finance the projects, that is a separate course. That is corporate finance, how to raise the finance in order to meet the requirements. That is going to be covered separately, whether it is through borrowings or whether it is through additional equity, whether it is through retained profits. These are all different avenues, but those are going to be covered in the corporate finance course. We are not going to examine the financing of the projects. We are going to examine how to decide which project to accept, and that you should have a budget which should give you a total amount of projects and total amount of capital expenditure that can be incurred. Decisions should be evaluated on the basis of their expected contribution towards the goals of the organization. So the first objective was to determine whether or not to accept a project, and now we are saying that this decision will be based on whether this project will make a contribution to the goals of the organization. The goals of the organization will, of course, include profitability. It will include enhancing the revenue, the sales. It will include enhancing the image and the reputation of the organization. So the projects to be accepted will be those that are going to contribute towards these goals. Theory of capital budgeting specifies that shareholder value is maximized where marginal cost is equal to marginal revenue. The second objective which we have discussed is how much capital expenditure to include in your budget, where to put a limit, how to decide how much expenditure we should incur. The economic theory which you must have covered tells you profit is maximized where marginal cost is equal to marginal revenue. So we are going to apply that same theory here in deciding where to include and where to end the capital expenditure, how much should be included in the budget. So we are saying over here that shareholders' value is maximized where marginal cost is equal to marginal revenue. Now we are looking at shareholder value. Here the cost, which is marginal cost, is going to be the cost of financing the additional project. So as long as your cost of financing the project, the next project, is going to be equal to the, we are saying marginal revenue here, the revenue is going to be the return from the investment, the return from the project. So the cost of the investment should be at least equal to the return from the investment. Now, most of us will know this, that as a firm continues to take on more projects, therefore it is going to take on and increase its expenditure, and that is going to be financed. Now the cost of finance we are calling, for example, the cost of capital. That can be equity capital or debt capital. Now that capital that has to be incurred, the cost of capital is likely to increase after a certain stage. If you, let's say that you are borrowing, just as an example, in case you are borrowing, when the borrowing reaches a certain level and after that you want to continue to borrow, perhaps the lender is going to demand a higher return or a higher cost. So therefore your cost is going to increase as your borrowing increases, because the risk associated with that is also increasing. This should be plain to understand that if you have a very large amount of debt, then the risk of returning that entire amount of debt is much greater than if you have a small amount of debt. So this is the point that is being made, that if you are going to keep on incurring financial cost, capital cost to add on projects, then that cost is going to go up. So you must always compare that cost with the return from the investment, and the point at which the return from the investment is the same as the cost of the additional capital, that's the point of maximizing shareholder value. So the next objective of determining how much capital expenditure, that is going to be determined by trying to maximize shareholder wealth and equate the marginal cost with the marginal revenue. Marginal cost is represented by the marginal cost of capital, and marginal revenue is represented by the percentage return on investment. This concept of marginal cost and marginal revenue we have discussed in our earlier sessions also, and this is of course discussed in economics. The marginal cost is the cost of the additional project. So as we said, as we are increasing our projects, we are increasing our cost, we are increasing our risk, the cost is going to increase with every new project. So the marginal cost of the project is the cost of capital of the next project. Similarly, the marginal revenue is the revenue or the return from the next investment. So the new investment and the new cost, those are the two that have to be compared. Cost of capital means the cost of funds to finance the project. Cost of capital, we said, is the cost of funds to finance. Now, financing can be from different sources. Financing can be from equity. Equity means the shareholders make a contribution or an investment into the project. It can be from retained earnings. Retained earnings are those which have been retained in the business. In other words, past profits. Profits earned earlier, if they have not been distributed to the shareholders, they have been held within the business. This is retained profit. So that is a source of financing new projects. And of course there is debt capital. Debt means borrowing. You can go to various outside institutions, financing, banks, etc. And there are several others means of raising finance. So the cost of raising the finance is the cost of capital. And so we will compare this cost of capital with the return from the investment and make sure that the cost is not higher than the return. Opportunity cost of investment. The rates of return that are available from investment in the financial markets, such as ordinary shares and government treasury bonds, represent opportunity cost of investment in capital projects. Opportunity cost concept is the same as we have covered earlier. It is the concept of the alternative foregone or the alternative sacrificed. That alternative which you chose not to adopt, whatever is the cost, that is the cost of your decision. So you have a pool of funds, and in this slide we have given the example of the stock markets and the financial markets, ordinary shares, government treasury bonds. So your funds can either be invested in government treasury bonds, ordinary shares, other financial markets like the stock exchange, and so forth. If you are investing these funds in the project, then you are not investing them in the financial markets. So that is the alternative sacrificed. So whatever return you can get from the financial markets becomes the opportunity cost of the funds. Those funds have been invested in the project, whereas they could have been earning the return in financial markets. So financial markets will represent the opportunity cost of funds invested in the project. And as we said, opportunity cost is the cost of the alternative which has been sacrificed. A firm should invest in capital projects if they yield a return in excess of the opportunity cost. So this is like a decision rule, the basis on which to make a decision. Whether or not you should accept a project, you should compare the return with the opportunity cost. We said the opportunity cost of these funds is the return that you can get from the financial markets. So in no case should you accept projects that are giving you a return which is less than the return from the financial markets. That's the opportunity cost. Our projects that we adopt and accept and invest in should be giving you a higher return. So that's the basis, and the decision rule then becomes that firms should invest in those projects where the return is higher than the opportunity cost. Opportunity cost being the return from the financial markets. The opportunity cost of investment is also known as the minimum required rate of return. Nearly the same thing that we say that we are going to accept projects that give a return higher than opportunity cost, that makes the opportunity cost as the minimum required return. So in your evaluation of the projects, if you want to decide what should be the minimum return we should expect from the projects of the firm, the minimum return should be what return can be offered in the financial markets, that is the opportunity cost. So the opportunity cost becomes the minimum required rate of return. Having said this, we are holding this discussion under certain assumptions, as we said earlier. There can sometimes be reasons for firms to be undertaking projects which provide a return lower than the opportunity cost, and those reasons could be strategic reasons. There could be a need for the firm to provide a certain range of products. In order to help the sale of one, you might need a fuller range, and even though the return from some of the products is not above the minimum required range, but because it supports the other products, therefore it might be appropriate to accept those projects. So therefore there are exceptions, and these are general rules under certain assumptions and under certain limitations. Concept of net present value, NPV. By using a discounted cash flow technique and calculating present values, we can compare the return of an investment in capital projects with an alternative investment in the capital markets. We are now discussing the concept of net present value. The financial management courses are going to consider these concepts in great detail, but because they are involved in decision making for capital investments, we are going to briefly discuss them. So we are saying that you can take the discounted cash flow. By using discounted cash flow techniques, basically the idea for us is to compare the investment in one project against the investment either in the financial markets or with some other project. Now, as a means and a basis of comparison, the discounted cash flows can be used. What is the meaning of discounted cash flow? Just to understand the basic concept of discounted cash flow. If you have 100 rupees today and you put that 100 rupees in the bank, and the bank, let's say, gives you profit, let's call it profit, on that 100 rupees of 10%. So after 1 year, the value of that 100 rupees is 110 rupees. The profit of 10 plus the 100 rupees. Now, this becomes, in a way, a future value. 1 year later, it is 110. Now, on that 110, again, if you hold that for one other year, in other words, after 2 years, then you will get 10% on 110, which is 11 rupees. So it will be worth 121 after 2 years. So present value is 100, value after 1 year is 110, and value after 2 years is 121. The discounted cash flow technique is bringing the value in years or periods, future periods, back to the present time. So it will be the same as saying that if you have 121 rupees after 2 years, that is in present value terms the same as having 100 rupees now at the present time. So this is what the discounting techniques do. They take the cash flows in future periods and bring them back into present value terms. All the cash flow inflows and outflows are examined in present value terms. What is the value now? And therefore, the concept of net present value means the net of the inflows and the outflows that you expect over several periods. What is the present value of those net cash flows? And that gives you a basis to compare that in present terms, in present value terms, what is the value of those cash flows. So we have said that by using these discounted cash flow techniques and calculating the present values, we can then compare various different investments. How to decide whether one project is giving better return or the financial markets are giving better return or another project is giving better return is to calculate all their cash flows in present value terms and then just compare them, which is the higher value. NPV is the present value of the net cash inflows less the project's initial investment outlay. So NPV, net present value, that therefore, now if you have an outlay, we said outlay is your expenditure that you are going to make. Usually that is the time that you want to compare, that is your investment. You want to compare that investment with what returns you are going to get in cash flow terms from that investment. So that investment can be taken as the current time, as the present time. And the cash flows that are going to arise over a period of time from this investment, those can be discounted into present value terms and compare the net cash flow over the period of time with the initial outlay, the initial investment, and that provides you whether or not you are getting a return and what is the return. If the rate of return from the project is greater than the return on investment in the capital markets, the NPV will be positive. If it is lower, the NPV will be negative. Net present value is going to be positive if in present value terms the cash flow arising over the period is greater than your initial investment. So that is a positive number. And if the present value of all those cash flows is less than your initial investment, then you will have a negative NPV. So a net present value, net amount, all the net inflows are less than the present outflow. Therefore, the net present value will be negative. So this is what we have to see in NPV terms, and by comparison of NPV, whether they are positive or negative. Positive NPV means the inflows are greater, means it is beneficial, and the negative NPV, of course, means that your inflows are less than your current investment, your current outlay. Therefore, that investment should be rejected and not accepted. Projects with positive NPVs may be accepted, whereas the negative NPV projects should be rejected. So now we have a basis for decision making. The NPV, therefore, is a criteria and a basis for making decisions on whether or not a project should be accepted. And so we are saying that positive NPV, those are the projects that should be accepted, and where the NPV is negative, the net present value is negative, those projects should not be accepted. Let's look at an example of the calculation of NPV. Here, the company called the Bannu Company is evaluating two projects with an expected life of 3 years and an investment outlay of rupees 1 million. So this company has two projects. The outlay, in other words, the investment for both the projects is the same, that is rupees 1 million. That is going to be incurred at the current time. And it has a life of 3 years. So both projects have a life of 3 years and require an investment of 1 million. So we have to compare by calculating NPV, which might be the better project. The estimated net cash flows for each project are as follows. Project A, year 1, 2, and 3. Year 1, the net cash flow for year 1 for project A is 300,000. Year 2, 1 million. Year 3, 400,000. So a total of 1.7 million is obtained from project A over a 3-year period. In year 1, 300,000. In year 2, 1 million. And in year 4, 400,000. Whereas in project B, the cash flow is the same each year, and it is 600,000 per year for year 1, 2, and 3. So each year the project inflows is the same, and the total is 1.8 million. Here the total is 1.8 million project B and 1.7 million in project A. The opportunity cost of capital for both projects is 10%. Calculate NPV for both. So we are given the cash flows of two projects, and we are told that the opportunity cost of capital, the cost of capital, which is the minimum rate for both the projects, is 10%. Let us calculate the net present value. That's what we are required to do. Two projects, two different cash flow streams, but same initial outlay of 1 million, same period of 3 years, and we know that the minimum required rate or the opportunity cost of capital is 10%. So let us calculate the NPV of project A. As you can see, we are showing the cash flows in the column under amount of 300,000, 1 million in the second year, and 400,000 in the third year. And then we have a discount factor. This discount factor is a factor to bring the future value to the present value. So we said if 100 rupees after 1 year is 110, then what is the present value of the 110? It is 100, and the way to bring it back would be to multiply it by 0.91, and you will get the present value. So that gives you the factor calculated by the rate of the cost of capital, and that is shown in the calculation in the slide. So the discount factor for year 1 is 0.91, which is calculated as 1 over 1.1. The discount factor for year 2 is 0.83, and the working is shown there, and the discount factor for year 3 is 0.75. Now multiplying by the discount factors, we get to the present value of this cash flow, and we can see that the total present value of all the 3 years comes to 1,399,650, and the initial outlay, which is current, therefore already in present value terms, is 1 million. So the net present value is 399,650. This is the NPV of project A. So here we have calculated the NPV of project A by using a discount factor at 10%. The calculation of discount factor, of course, will be covered in your finance courses. Here we are going to just refer to the discount factor and the calculation the way it is done. NPV of project B. When the cash flows are the same each year, that is an annuity, and the annuity factor is used instead of the discount factor. Annuity factor and discount factor are essentially the same. We are going to use every year's cash flow and multiply by that year's discount factor where the cash flow is different. But when the cash flow is the same every year, it is the same amount every year, as in project B, where in years 1, 2, and 3, all 3 years, the cash flow is 600,000. So this is an annuity for 3 years of 600,000. Here, the annuity factor can be used instead of the discount factor. So here, the annual cash flow is 600,000, and the annuity factor at 10% for 3 years is 2.487. So the present value of 3 years cash flow of 600,000 amounts to 1,492,200, and our investment, which is in current value terms, is 1 million. So here the net present value is 492,200. So the net present value of project B is 492,200, and quickly we can go back and see the net present value of project A is 399,650. So here we have used the net present value technique to compare project A and project B. A had a different cash flow each year for the 3 years, and B had the same cash flow for 3 years. And we used the discounted cash flow technique to arrive at the present value, and then deducting that from the initial investment, it gave us the net present value. In our example, the net present value of project B is higher than the net present value of project A, and therefore the decision would be to accept project B as it has a higher net present value. It is going to give you a better return. So this is the use of net present value techniques in evaluating different projects. That's all for this session. Thank you very much.